in general, right? I am not really a fan of getting into stocks heavily right now, besides just for diversification purposes. This here is the stock market's valuation relative to the price to earnings ratio. It's now at very similar levels to the dot-com bubble. And yeah, we know what can happen afterwards, right? When the dot-com bubble deflates, prices go down. Subsequently, we had the global financial crisis. So even the dot-com deflation wasn't enough for the market. What we've got over here, that's depression, right? The depression of the 1930s that subsequently led to so much pressure in various world economies that it led to World War II. It's hard to say whether or not from peak to peak we actually see rising PE ratios. There are some arguments for potentially long-term rising PE ratios, that maybe stocks should, over the long term, appreciate versus their earnings, because now more and more investments are being done in stocks. There's basically adoption of the stock market. Everybody invests in 401ks, etc. So there is that. There's also more and more support by the government for the stock market. There's artificial propping up of the stock market through monetary debasement whenever we crash. So the US dollar is less safe. So that's maybe why there's a flight towards the stocks. So there is a reason to believe why we could potentially be at a higher peak. That being said, still just looking at this long-term chart, right? Looking at a chart that starts in 1987, we're definitely not cheap in the stock market. So that's a potential problem with buying dips for the long term in tech. There's another problem. Have a look at the NASDAQ relative to the S&P 500. So this is now a chart of how expensive are tech stocks relative to stocks in general, right? So within the stock market, how expensive are tech stocks? What we see here, right, with the square, that's the dot-com bubble. So we had a quick acceleration of tech stocks. Tech stocks outperformed the rest of the stock market by more than 200%, and that got corrected very, very quickly. But then we also see how very long-term tech stocks tend to underperform other stocks. And we also see that even if there was an AI bubble right now, how the AI bubble did not accelerate tech stocks much more compared to regular stocks. So we don't see this quick spike. The valuations are high, but the momentum isn't that extreme that would tell us, okay, we will see a burst very, very quickly. If things are coming down, if the stock market was to sell off, it's probably going to be the entire stock market. It's not going to be just a dot-com crash. It might be labeled the AI crash, but I don't think that it will be just the tech stocks that will come down. Probably everything will come down because PE ratios are simply so high. Tech stocks, relative to regular stocks, they are expensive, but they did not necessarily appreciate as quickly as they did during the hype phases at the end of the 1990s. Now, what about specific stocks? Right? So what about Microsoft, Amazon, and Meta? What I like to look at is always relative valuations. So we can simply enter those stocks in TradingView. So MSFT relative to the NASDAQ. And then we just check whether or not the idiosyncratic risk that we currently have with something like Microsoft is worth it. And when we just see this, right, when we see this chart, really, we didn't have any outperformance of Microsoft versus the rest of the tech market in the last 30 years. And we did see a dip that was above average, but it hasn't dipped as much compared to, say, the Steve Ballmer times. So we are not at a historical bottom, right? A bottom like this one over here. So things could potentially get worse, right? Microsoft could potentially fall another 40%. So I'm not really convinced to buy this just yet, just regarding how much outperformance we might get. I think Microsoft just performs according to any other regular tech stock right now. And I think it's best to only buy it when it's really clearly cheap. Because the outperformance isn't long term, and because it's not clearly cheap right now, I wouldn't necessarily get into Microsoft for the long term. Let's look into Amazon. So it's Amazon relative to the NASDAQ 100. That's this chart. Here that tends to be a bit more outperformance, but still over the last 10 years, it's not really that obvious, right? So Amazon isn't necessarily doing that well. So again, it's not necessarily something I'm super interested in buying idiosyncratically. You can simply just buy QQQ and you'll get the similar kind of performance without the idiosyncratic risk of a single stock. Let's have a look at Meta. Here's Meta relative to the Nasdaq 100. It's on a downward trend, but it has crashed before much more. There are different reasons for those crashes though, right? So this here was the question whether or not Facebook will also get enough adoption on mobile phones. At the time, the mobile phone adoption was really, really poor. And so Facebook crashed. Then they were able to improve their app, were able to not just build this on a React-based app, but had their own applications for individual platforms that then improved loading times, improved adoption for the mobile platform that helped. The subsequent crash was the malinvestment in VR, right? So over-investment into virtual reality that didn't get the adoption. That got then dialed back down. Now the VR investments are way more, let's say, they're way more realistic relative to revenues. They're still ongoing, there's still new Quest developments, but they're not as aggressive as they used to. And because of that cost cutting, Meta was able to bounce. And yeah, let's see what happens here, right? Maybe if the AI bubble was to suddenly crash, we could see another dip, and that would put it down to roughly by 60% versus the Nasdaq 100. So yeah, I'm not necessarily a fan of getting overexposure to any stocks right now, and especially also to most individual tech stocks.